Jupiter, or JUP, isn't just another Solana token. It's the backbone of Solana ecosystem, powering billions in volume and now expanding into an entire DeFi universe. With Solana price action heating up, could JUP be setting up for a breakout in the bull market? Jupiter, known by its token ticker JUP, started out as Solana's leading decentralized exchange aggregator, routing trades across liquidity pools to give users the best price execution for both spot and limit orders. Over time, it expanded its offering beyond simple swaps to include perpetual futures trading, lending integrations, and advanced order types, quickly becoming the go-to venue for decentralized trading activity on Solana. Today, Jupiter is not only a core liquidity hub powering the majority of Solana's on-chain volume, but also the foundation for a broader vision, the Jupiverse, where developers, communities, and token projects can launch, manage, and govern assets transparently under one unified ecosystem. Jupiter price action and bull run price prediction. Looking at Jupiter's, JUP, current price action on the daily chart, the token is trading around 53 cents after a pullback, hovering just above the 38.2% Fibonacci retracement level at $0.5187. The Elliott Wave structure suggests that JUP may have completed a corrective wave 2 and is consolidating before potentially entering a stronger impulsive wave 3. Key short-term support sits within the retracement zone between 51 cents and 47 cents, while deeper downside protection aligns with the 61.8% level at 43 cents. If the bullish count plays out, the next impulsive leg could aim toward the $1 to $1.30 region over the medium term, with further extension possible if broader market momentum supports Solana ecosystem assets. This would be just beginning, as some analysts also speculate that price could go as high as $10 in case of full-blown bull run 2025 to 26. Jupiter Tokenomics. Jupiter price speculation is translated by Jupiter's tokenomics and development. The tokenomics is built around a maximum supply of 7 billion JUP, of which roughly 3.1 billion tokens are currently circulating, is almost equal to 44–45% of max supply, leaving the remainder subject to vesting, strategic reserves, community allocations, and other locked buckets. Team allocation sits materially but not overwhelmingly high, on the order of 1.3–1.5 billion JUP, roughly 20% of supply under the current plan, and has a meaningful cliff plus scheduled releases. Strategic and community reserves together represent another large chunk intended to fund ecosystem growth, DAO incentives, and future protocol initiatives. A DAO, decentralized autonomous organization, in Web3 is a community-governed organization run on smart contracts, where rules and decisions are enforced transparently on-chain, and members vote using tokens instead of relying on centralized management. Jupiter Community-Driven Protocol. As JUP is now run by community decisions, therefore community places heavy emphasis on transparent schedule publishing. Unlocks are documented via the project's lock/vesting tools and DAO disclosures and are governed by the vesting terms agreed by DAO decisions. Community governance and DAO mechanism. Governance via the Jupiter DAO is central to how tokenomics evolve. The DAO actively votes on reward funding, vesting adjustments, and long-term alignment proposals through the formal on-chain voting interface and public discussion forums, and several governance vehicles now directly affect supply dynamics. One key protocol of on-chain governance is the Active Staking Rewards (ASR) framework, which was designed to incentivize meaningful participation rather than passive holding by funding rewards to active stackers who vote and engage. ASR's methodology ties reward allocation to per-proposal participation so that proposals with lower total voting power can yield higher per-voter ASR to encourage engagement, and ASR funding itself is periodically subject to DAO renewal votes. Fundamental analysis. For JUP price actions, we use metrics such as total value locked, TVL, token supply and inflation schedule, ecosystem usage, and governance/staking rewards. Revenue growth. Jupiter is a decentralized exchange aggregator on Solana. Its revenue comes from transaction/swap fees. Total value locked is $4.3 billion. Annual earnings of $309 million. DEX aggregator volume of 30 days is $22.3 billion. With its market cap of $1.72 billion and current price 55 cents, JUP has huge potential if full-blown bull run explodes. You may check the income statement at DeFi Llama. I will drop the link in the description. Don't forget to like, subscribe, and press the bell icon. Tokenomics supply trends. Total supply is 7 billion JUP, but not all circulating. Circulating supply is around 3.1 billion tokens currently. There have been airdrop events. Large token unlocks, e.g. 700 million JUP, unlocked in January 2025, which have pressured price. There is also a community-approved proposal to reduce maximum supply from 10B to about 7B by reducing emissions enacted already. Recent tokenomics and DAO role. Jupiter DAO has become much more active in shaping the tokenomics via a formal governance process. One of the key mechanisms is ASR active staking rewards, which rewards users who stake JUP and participate in governance, voting. In its methodology, voting power is calculated by both amount of JUP staked during votes and the number of proposals a user participates in. This is meant to discourage passive holding and encourage active governance participation. Rewards are allocated per proposal, rather than lumped across all proposals. Proposals with lower total voting power attract more reward per voter. ASR was initially funded by 100 million JUP from the LFG launchpad fees and was designed to run over 2 quarters. Renewal of ASR funding is itself subject to votes. The lock system is an open-source, audited smart contract program that allows any project or token holders in specific buckets to set up token vesting, cliff periods, and time-based unlocks. It's a tool under the Jupiverse infrastructure that provides transparency and discipline around how supply is released. Tokens locked via this system are non-transferable until unlock conditions are met. This gives the community clearer visibility into when future supply enters circulation. Another important vector is the DAO's treatment of rewards and governance participation, e.g. ASR. There have been active proposals under DAO processes related to adjusting ASR rewards under time-weighted models, changing staking periods for eligibility from 30 days to 14 days in some proposals, and discussions around minimum staking amounts to claim rewards, e.g. proposals to set minimum JUP staking threshold so dust amounts don't clutter the system. These show ongoing refinement in how reward versus participation or stake trade-offs are being managed. On the borrowing or liquidity side, there is JLP loans, Jupiter perps, or borrow USDC via JLP, which ties into tokenomics more indirectly. It increases utility for liquidity provider LP positions, giving options to borrow or leverage positions, potentially increasing demand for JUP and JLP-related operations. While this doesn't directly change total supply or vesting, greater utility can help absorb supply if usage rises. Implications and key observations. Putting all this together, several important things emerge. The DAO is increasingly central to how supply and reward mechanics are governed. Token unlocks, team allocations, bonuses, and vesting are no longer just protocol founder decisions but need community buy-in. The ASR mechanism ties tokenomics to governance behavior, which helps align long-term interests and discourages selling or short-term speculation by rewarding those who stake and stay involved. Vesting tools being publicly auditable and open source improves transparency. Community can see when tokens are locked and when they will unlock, which lets stakeholders better model dilution and supply risk. Utility features like JLP loans, staking, governance, launch tools help generate demand, which is needed to absorb supply as unlocks happen. Community ownership. Because this is a crypto protocol, insider ownership is less clearly defined in the equity sense. There is a strong governance token model. Holders of JUP can vote on protocol decisions via the DAO. Sector and macro view. Jupiter sits in the DeFi or DEX or aggregator sector, especially within the Solana ecosystem. The sector has been evolving rapidly. Growth in total value locked, TVL, innovations in liquidity routing, cross-chain interoperability, and increasing demand for cheaper, faster transactions outside Ethereum's high-fee paradigm. On the macro side, relevant trends include rising regulatory scrutiny of crypto, especially DeFi, macroeconomic tightening, which reduces risk appetite, institutional adoption, and competition among blockchain layers. Also, Solana's own health in terms of uptime, network congestion, protocol improvements, etc. matters heavily. Jupiter's competitive positioning is decent. It is one of the leading aggregators trading infrastructure layers on Solana, with strong community engagement, a relatively large TVL, and growing features, e.g. limit orders, TWAP, perpetuals, Jupiter DAO, etc. However, it is less diversified than some rivals. Its dependence on Solana means it inherits Solana's network security or regulatory risks. Jupiter from a DEX to Jupiverse Expansion. A story of Biddle. Jupiter is building out what they call a Jupiverse, a collection of developer toolkits, services, and governance or community modules that let projects launch, manage, and transparently vest or lock tokens under Jupiter's ecosystem. The idea is to give both creators and the community more control, clarity, and trust in how token supply and utility are managed. On the dev.jup.ag side, Jupiter offers multiple SDKs, APIs, and ready-to-use tools that go beyond just swaps. These include Swap API, Ultra API, Token API, Price API, Trigger, Recurring, Lend, etc., so that developers can build full DeFi apps, automate recurring swaps or transactions, integrate complex state transitions like triggers, or build entirely new products using Jupiter's routing and liquidity infrastructure. There are toolkits like the Jupiter plugin, which allows embedding swap UI into websites with minimal code, mobile adapter, unified wallet kit, and the Jupiverse kit, React components, DevRel examples. So projects can plug in Jupiter's features quickly rather than build everything from scratch. This lowers friction and helps more tokens, dApps, projects join the Jupiter ecosystem. Jupiter Token Studio and Launchpad. One key component is Jupiter Lock in beta, which is a token locking plus vesting tool that any project can use. With Jupiter Lock, projects can configure vesting schedules, cliff periods, unlocks, and even burn tokens by sending them to a burn address, all via smart contracts. It is designed according to principles Jupiter calls CAT: certainty, alignment, transparency. For token holders and the community, Jupiter Lock provides visibility into which parts of supply are locked versus circulating, what the vesting or unlock schedule is, who holds which slice, team, pre-sale investors, etc. It is audited, some audits already done, more in progress, and intended as a public good. Projects can use it without needing business development outreach, i.e. freely. Another part is Jupiter Studio, which is the token launch and management platform. Launched circa mid-2025, Studio is meant to allow users or community or DAOs to launch SPL tokens on Solana with minimal technical barrier. No need to write smart contracts manually, no deep coding needed. It supports preset launch modes, e.g. play, locked in, full send for different scales, but also allows custom settings, vesting percentages and schedules, lockups, tokenomics parameters, swap fee settings, etc. Tokens launched via Studio gain integrated exposure in the Jupiverse ecosystem, meaning visibility, credibility, interoperation with Jupiter's tooling, and use of Jupiter Lock for locking or vesting. In governance, Jupiter DAO plays an active role in approving or guiding long-term alignment decisions. One example is the Meow's 2030 lock-in proposal, a proposal by a core team member to allocate 280 million JUP with a 3 to 4 year vesting schedule, fronted from strategic reserve or other allocation, and to lock in for 5 years, asking for bonus reward later. Such proposals indicate that not just passive vesting schedules are used, but active community or DAO decisions can adjust how allocation and lockups work to signal long-term alignment. Overall, the Jupiverse is a layered system, base liquidity / routing / swap and API infrastructure, plus tools for token creation, token management, governance, and community engagement. The goal appears to be making tokenomics more transparent and giving smaller or newer projects the infrastructure to manage supply responsibly, while maintaining alignment with token holders and community expectations. Valuation metrics. Jupiter's market cap is about 1.7 to 1.8 billion US according to different sources. With TVL $2.5 billion, that gives a cap or TVL ratio 0.7x, which is reasonable for a DeFi protocol but implies expectations of further growth. Among Solana DEX aggregators or AMM's protocols, some have higher or lower depending on functionality, risk, decentralization, etc. Catalyst to watch. Token supply adjustments. ongoing token emissions or reductions, emission schedule changes, possibly further token burns or strategic lockups can be impactful if any big changes happen, as scheduled tokens are minute like 1% and won't be impacting the price much. But keep vigilant. Platform feature rollouts, improved user tools, limit orders, advanced routing, perpetual futures, etc., integrations, partner protocols, and such more features could be luring for DeFi community. BUIDL brings the price impact. Building features translates into price action. Solana network infrastructure upgrades, performance or security incidents on Solana could impact trust and usage. Short-term catalysts, announcements of new integrations/partnerships that increase usage and fee revenue. Major token unlocks or schedule transparency being communicated and managed to reduce negative market reaction. Increased staking or governance engagement, which could create demand pressure for circulating supply. Long-term catalysts, further growth in Solana DeFi activity, particularly if Ethereum congestion or fees remain high. Expansion or cross-chain capability, if Jupiter supports or bridges to other chains. Strengthen governance and DAO execution, enabling responsive improvements. Concluding all this, as Jupiter continues to mature, its future will hinge on the delicate balance between supply unlocks, DAO decision-making, and product adoption within the Jupiverse. The introduction of tools like Jupiter Lock, Jupiter Studio, and ASR staking rewards shows that the team and community are actively working to align incentives, build transparency, and create real utility for JUP beyond speculation. But with upcoming unlocks, ongoing governance proposals, and the constant pressure of competition in DeFi, investors will need to stay closely engaged with DAO votes and ecosystem growth. Whether JUP becomes the central liquidity and tokenomics hub of Solana will depend on how effectively it executes this vision. But what is clear is that Jupiter has carved out a unique position as both a protocol and a platform, giving it the potential to define the next stage of Solana's DeFi expansion. If you found this breakdown on Jupiter helpful, make sure to hit that like button, subscribe to the channel, and turn on the notification bell so you don't miss the next deep dive into DeFi and Solana's fastest growing projects.